Hello everyone, it's me the Boss Hog, and today we're going to be looking at my buys, sells and dividends for the week ending the 11th of February. Let's do it. Okay, so feeling mostly better this week. I think I had a chest infection previously, but I'm definitely on the tail end of whatever I had, so there should be some more videos coming up, including this one. A pretty good week overall, but with a big caveat really. If you look here at the table top left, I've updated it to show a split between US and UK, as well as a traditional total that I've been doing by day. You can really see it peaked on the 9th there when both the US and the UK shares did really well. But then the US especially fell back, and I'm kind of expecting a similar thing to happen in the UK on Monday. UK shares have definitely been outperforming the S&P since January. But really, for me specifically, I've been outperforming both over the last week at least, because National Express, my largest holding, is up 15% in a week. So that made a huge difference and really underpinned my week. It was responsible for about 90% of my profit. So, without that, it would have been pretty flat. Other notable changes here: Genius minus 4%, Poly plus 6%. This is Polymetal. Salesforce minus 5%, Disney plus 3%. Could have been more and was more on big earnings, but then obviously the whole market had a sell-off on Friday, and Google also down 6%. In case anyone's new here wondering how I rank these, it's basically the impact they have on my portfolio. So broadly speaking, it'll be size times percentage movement, and then I put it in an order. And they have to have at least £1,000 in them to qualify for this list. So that's how that works. Yeah, like I said, great start to the week. On the 9th, I was actually at the most my portfolio had ever been at. Was just over 110,000. But yeah, it's since fallen back, so that's a bit of a shame. But again, moving in the right direction. This week I decided not to add any capital. I had an audit at work, month end, and I also had a big presentation for my board at work. So I just didn't have any time to really look at what I wanted to spend money on this week. When I did on Friday, when I did start thinking about whether I wanted to put money into anything, I just decided not to. I was only going to put in £200 this week anyway, because I had a top up last week. But in the end, that didn't happen. So I just didn't have the time or the real. Nothing really stood out to me last week, so I decided I'd just wait. I continue to trade fairly actively. I'm honestly surprising myself now, 15 months in, how active of a trader I actually am. It is what it is. This time, though, I think it was they're absolutely fine. It was kind of a common. Well, most of it was really just selling off and re-diversifying, and actually looking to take advantage of some Russian-focused stocks. Really this week, as you'll see in a second, a bit beaten up in my opinion, and kind of a bit of a disconnect between the fundamentals and the situation at the moment, which is admittedly a little bit scary. Some divvies this week, but just a couple you can see there. I would say that all of these, all three of these, I mean, obviously everyone knows Apple. I have a tiny stake in Apple, more or less just to monitor it in case I get the chance to really buy something, probably under 150, but that doesn't look like it's coming true anytime soon. The other two here are basically small growth stocks. Cerillion here, especially in the middle, is going to become at least a medium-sized focus for me. It's a very small company, but it's like smack bang in my area of expertise. I feel very comfortable with it and think I've kind of got a bit of a gem here. So I do expect this dividend amount to grow in the future, just because I've been buying shares in it. And Dot Digital, can't quite make up my mind here, but again, it's another smallish, profitable though, UK company. Its results are in line with expectation. It got hammered. I just can't quite decide if I want to average down or not, so I'm on the fence with that, but not huge dividend movement this week, to be honest with you. Anyway, that done, let's have a look at what I've been buying this week. All right, so yeah, so to start with, actually, when I was putting this together, I was kind of surprised at how much I'd actually spent on Everaz. I've been in Everaz now, I think this is even my 4th or 5th time. I've made some good money on it, and I'm basically back into it. My average at the moment is in the high 400s after I've bought these shares. I basically bought shares at 475, 450, and 425, so I've just been kind of following it down. I'll be buying some more shares at 400. To me, I think the share price at the moment is massively disconnected from reality, from production, etc. But in fairness, for some good reason, because this is an oligarch-heavy company. 5 oligarchs own 55% of the business, and it is plausible that they will be targeted for any sort of sanctions. And on top of that as well, they're divesting their coking coal arm. So as of Monday, 14th of February, basically that's going to be spun off, put as a separate company on the Moscow Stock Exchange, Many people, myself included, will be forced to sell their option on that. So I am expecting basically cash back from that sale, but at the moment it's clouding the whole thing. My main point here is that more than 80% of the earnings for Evraz are from iron ore. Iron ore's had a bit of a bounce back from the sub $100 it was at. And therefore, if you look at the price and the behavior of this compared to sort of your Rio Tintos or your other iron ore heavy miners, it's just complete disconnect at the moment. And yeah, to me, I think it's probably about 40 to 50% undervalued. And I think, although there's some risk here, I'll accept. I think that kind of risk premium is too high. So yeah, for me, I'm buying Evraz for that reason. Definitely one for the brave, but I'm feeling quite confident about it in a way. Polymetal is also similar. This is a gold and silver play with, again, significant mining presence in Russia as well as surrounding countries like Kazakhstan. And again, it's not really in favour at the moment, both because of the situation with Ukraine, as well as the fact that gold and silver hasn't had a great commodity run as well. So I decided just to average down on this as well. Big dividend, but still pretty red, regardless of any dividend yield as it stands currently. Next up, I mentioned Cerulean, so I am buying anything under £9. So for me to be buying this at 7.48 feels really good. It does still trade on a fairly chunky forward multiple, in the low 30s. But again, for me, I understand this business extremely well, literally what I do for a day job, and I just believe that they've got in place now a solution that's going to scale extremely well. It's quite hard to build sort of a telco billing software as well as CRM and wider BSS stack. But once you're there, it's extremely scalable. And basically, they're going to be selling the solution to utility companies, and it's a good solution. It's a solution I would consider buying. And again, I feel very comfortable here with that. So I wanted to call that out. It's a very small company, but I'm going to make it a more material part of my portfolio in due course. Kainos is kind of similar, slightly less in my area of expertise, and also extremely expensive, but I really like what they're doing. I wanted to put this in here because even though it's a small amount, I sold this just a couple of weeks ago at £16, all but one share. But now I decided that as it got closer to 15, I was going to buy another 4. As a result of that, I'm basically flat again, so that's okay. I would really like this under 15 in order to make more of an aggressive move, but basically I had some money left over from my Evraz buy. And decided I'd just put it into Kainos while it was having a bit of a drop there, so that's exactly what I did. And lastly, I did just also want to talk about Fever Tree because this is a company I made solid money on beforehand. Didn't time the exit perfect, but in fairness, I chucked that money at National Express, which turned out to be a great decision. But I bought a couple of shares, 6 actually, after their latest earnings when their share price got absolutely hammered, like minus 40%. Because it looked like it was overdone, and basically the more I thought about it, the more I read, the more I decided that it is overdone. I think the costs are genuine. I think people are fair to point out the pressure that's going to have on earnings. But for me, I did a video on Fever Tree where I highlighted it was going to be about their success with tonics, other tonics, basically other mixers, their success international sales, and their success holding up of off-trade sales, so basically via supermarkets to people, as on-trade pubs and restaurants recovered. And when I looked at their results, all 3 of those things are basically showing stellar growth. And so for me, I think costs can be mitigated both as a combination of things feeding through supply chains as well as sort of looking at supply agreements, the normal stuff where you look at your costs. I think those things are manageable for a company of this kind of size, and they should be getting on top of it. So really for me, the underlying reason for me holding this stock, if anything, was improved. Those 3 key drivers are all doing great, and even arguably the UK, which is a saturated market supposedly, was plus 15%. To me, that was really impressive. Arguably the most impressive part of their results. So yeah, I actually was very confident buying these shares. I did average up. My first 6 shares were at under £20, so I think I got a bit of a bargain there. But really, I still think under 21 here, this is a fairly easy buy, to be perfectly honest. If anything, the more I think about it, the more I'm kind of bullish on that. So I might even go a bit higher. But I'm going to basically continue to drip feed into Fever Tree under £21. Because I think there's sufficient safety margin there, and like I say, the revenue is looking really promising. So yeah, I wanted to talk about that a little bit. I didn't really want to talk about the others because I felt like I've spoken about them before or recently. So, but any questions, standard stuff, put them in the comments below, and I'll get back to you. Anyway, let's have a look at what I sold. All right, so I actually want to talk about all of these, although fairly briefly. National Express, this is my largest holding still. I've sold now about 25% of this, and yet it's still very comfortably my largest holding. My plan here originally was to sell just 2,000 of my 10,000, but I've just sold this additional 550, and I think I'm actually going to keep on selling down to about 6,000 shares, try and get a price of around 285 to 290 across those 4,000 stocks. At the moment, my average is probably about 273. So that's okay. Part of this is also like, I think the stock is basically worth about 320. So it's no longer the bargain that it was when I was picking these shares up, you know, the 220 region. And I wanted to put some more money into sort of EVRAS and a few other things as well that I think are more undervalued now than National Express. But to be honest with you, even more than that, I grew increasingly uncomfortable having 25% of my portfolio in a single company, especially a company that, you know, you have to be a little bit brave on. You have to assume it's going to be a winner in consolidation. It's going to transition correctly to EVs. It's going to, have good expansion internationally. There's a lot of risks here, and so for me to take money off the table with a 20% profit, especially because I think there are opportunities at the moment in sort of tech and mining, I'm okay with it basically. Again, I wish I'd sold sort of on Wednesday when it was like 285. And I did sell like 150 at that point, but I also sold some at like 272, so that dragged down the average. So yeah, I'm not currently buying. Interestingly, if National Express went back under 240 and it was flirting with it just even a week ago, I would buy some more. I think that's the kind of level that I'd be looking to buy some more at. But for now, I'm happy to sort of trim down my exposure here and take some profits. This one may be a little bit more controversial because I've spoken about the fact that I think Legal & General is arguably the finest insurer to invest in the UK at least. It's an incredibly well-balanced business. Interestingly, I also have a 320 buy price for this as well, target price. So selling at 287, again, you could argue here I'm sort of leaving 10% on the table. But again, I wanted to free up some money, in this case, again, for EVRAS. And so that's exactly what I did, right? And again, if you accept my argument about EVRAS being sort of 40%, 50% undervalued, and basically moving from a share that I think might be 10% undervalued with a dividend, admittedly, to EVRAS, which I think is 40 to 50% undervalued and with a dividend as well. And in fact, the biggest, highest paying dividend payer in the FTSE 100. So I think that's okay, basically. I would like to get back into Legal & General, anything under 270. It's such a good business. I don't think you really need much margin of safety. And for me, this is one of those like sleep well at night kind of stocks. And I guess I just decided like last week I wanted a bit of Russian spice and make things a little bit of a gamble. So that was my reasoning there. Maybe slightly controversial. I'll definitely accept that because I do think Legal & General is a really good company and deserves some attention. So I feel like I should it's going to be interesting reflecting on that in a little while. Another one actually, so this is Restaurant Group, which is my wife's pick. In tribute to Peter Lynch, who also got some stock suggestions from his wife. My wife has been picking stocks. This is her third choice. Both of the other two are profitable as well, so that's great. This one was the one I was most nervous about, but they released results probably about 4 months ago now, and it really made me feel a lot better about the investment. I've basically been almost swing trading this a little bit, buying sort of in the mid 90s, selling in the mid 10x's, and basically taking 10% off the table each time. I'm keeping my exposure very limited here, and yeah, I just freed up a little bit of money. And to be honest with you, I think I've still got another 200 odd shares in Restaurant Group. I think next week I'm going to sell this right down to like one, just to keep an eye on it, and probably look to put it in T row or something like that as well. So we'll see how that goes. But yeah, so that was my rationale here. I do like a lot of the chains that Restaurant Group has under its banner. Wagamama in particular, I think, is quite well liked and has very good margins. And I like eating there as well, as is my wife. So that was part of that rationale as well. And lastly, I just trimmed a further share from Goldman Sachs and JP Morgan. This is really just because I think T row has kind of overly fallen. I know it's kind of got some exposure to wider economic sentiment, but I still think it's a good company that's now, like, most of its metrics are behind its sort of 5-year averages. Whereas, I'm up like 11% on Goldman Sachs and JP Morgan because I timed a recent buy very nicely. So, 10% in a month feels really good. And I just decided basically to have equal weighting across my 3 Yank banks. I know T Rowe isn't quite a bank, but I just like the term. So that was the rationale here. Basically, I've now got about 0.8% of my portfolio in each of them, so about 2.5% overall, and I feel good about it. So yeah, no, I think actually T Rowe I will continue to buy. I'm down a couple of percent on it at the moment. I think I'm in at 152 as an average, and for me, you know, selling profit taking a little bit to buy some of this, that feels absolutely fine. So that was my rationale there for just selling GS and JP Morgan. To be honest, I think JP Morgan is the one I'm least excited about from a value perspective, because I think it does trade on quite the premium. It's very diversified. I totally get it. Probably deserves some premium. But Goldman Sachs is trading close to book value. T Rowe as well, like as I've already discussed. So to be honest with you, if I was going to buy any more of these, I'd probably actually lean toward Goldman Sachs and T Rowe over JP Morgan would be my thinking here. Anyway, my voice is starting to go, so I'll wrap up there. Thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.